Somewhere between your first paycheck and right now, somebody should have taught you dividend investing. They did not, so I'm going to, from scratch in one video. 20 minutes from now, you are going to understand dividends better than most people who have been investing for years. You are going to know how the dividend machine works, how to spot a trap before it costs you money, and how to read any investment's track record in under 60 seconds. You are going to have 5 investments picked, a portfolio built, and in the end, I will show you how this portfolio, using $5 a day, less than a coffee, is projected to reach over $800K valuation and pay over $6,600 a month. I broke this video into 3 parts. The first part is the machine, what dividends are, how they grow, and the loop that makes them compound on their own. Nothing else in this video makes sense without it. The second part is the filter, how to tell a good investment from a bad one, how to spot a trap before it costs you money, and how to read any investment's track record in under 60 seconds. The third part is the build, 5 investments, $5 a day, inside a Roth IRA, and a 30-year projection that shows you exactly where it all ends up. Let's start with phase 1, the machine, and it starts with one question. What is a dividend? Some companies make more money than they need to run the business. When that happens, they take a piece of those profits and send it directly to the people who own their stock. That payment is called a dividend. You do not sell anything, you do not time anything. You own the stock, the company earns money, and they send you a cut, usually every 3 months. So if you put $1,000 into a stock with a 3% dividend yield, that is $30 a year just for holding it. That is passive income. The money shows up whether you check the account or not. Now here's what I need you to remember. That $30 does not stay $30. The company does not just pay you the same amount forever. And that is where the machine actually starts. Good companies raise their dividends. Every single year the payment gets bigger, even if you never buy another share. If a stock pays you $100 in dividends this year and grows that payment by 10% a year, next year you would get $110, then $121, then $133. You didn't do anything. The company just decided to pay you more. That rate of increase is called the dividend growth rate, and this is the number I need you to pay attention to for the rest of this video, because it matters more than the yield, more than the stock price, more than almost anything else people look at. A stock paying 2% today with a 12% growth rate will be paying you more in 10 years than a stock that started at 5% with no growth at all. This is based on just 12% growth. Later in this video, I will show you one of the 5 investments in this portfolio that has a dividend growth rate above 19%. More on that later. For now, you need to understand that good companies grow their dividends every year, but there is one more piece, and it is the one that turns little money into big money. The compounding loop. When you receive a dividend, you have 2 options: take the cash or use it to buy more shares. If you buy more shares, those new shares pay dividends too. Those dividends buy more shares. Those shares pay more dividends. The loop feeds itself. Early on, it looks like nothing is happening. If you invest $1,000, get $30 in dividends, reinvest it, and now you have $1,030 working for you. Next quarter, slightly more. The numbers are small. That's normal. The loop is running, you just can't see it yet. And here's the part people skip. You do not have to do this by hand. Most brokerages have a setting called a DRIP, a dividend reinvestment plan. Turn it on and every dividend payment automatically buys more shares without you lifting a finger. One toggle and the compounding loop runs on autopilot from that point forward. So that is phase 1. You have the full machine now. Dividends come in, they grow every year, and the compounding loop reinvests them so the snowball keeps building. I will show you 2 more phases of dividend investing, and by the time all 3 come together, I will show you a portfolio that is projected to reach over $800,000 in value and pay over $6,600 a month on just $5 a day. But that only works if every investment in the portfolio deserves to be there, and the wrong one is not always the one that looks bad. Sometimes it's the one that looks too good. That is what phase 2 is about. The filter, how to tell the difference before it costs you money. The yield trap. If you are scrolling through dividend stocks and you see one paying 9 or 10%, everything else is paying 2 to 4%, it looks like the obvious choice. It is not. And this is the most important lesson in this entire phase, because a bad pick does not just lose money, it breaks the machine you just learned how to build. A good example of this is Walgreens boots. By late 2023, Walgreens was yielding around 9%. It had paid dividends for more than 90 straight years, over 360 consecutive quarters. Nearly 50 years of dividend increases in a row. On paper, it was one of the safest dividend stocks in America. It even carried the title Dividend Aristocrat. But underneath that 9% yield, the math was broken. And here's how you would have caught it. There is a number called the payout ratio. It's simple. It tells you how much of a company's earnings goes out as dividends. If a company earns $2 and pays $1 as a dividend, the payout ratio is 50%. That's healthy. Walgreens was at 291%. For every dollar the company earned, it was sending nearly $3 out the door. The stock price had been sliding for years. Earnings were falling. Free cash flow had turned negative. In January 2024, the dividend cut came. Walgreens slashed its dividend by nearly 50%, from 48 cents per share down to 25 cents. The 47-year streak of increases was over in one announcement, and the stock price did not recover. It fell 64% over the course of that year. Investors who bought for the yield got hit on both sides, less income and a collapsing stock price. By 2025, the company was delisted from the Aristocrat list entirely. Think about what that means for the person who bought Walgreens at a 9% yield. They were collecting roughly $90 a year for every $1,000 invested. Then the cut came, and that dropped to $50. Then the stock price collapsed and their $1,000 was worth $400. Less income and less money. The 9% yield that looked like a shortcut turned into the most expensive mistake in their portfolio. Walgreens was not an outlier. 3M cut its dividend after more than 60 years. Dow cut after decades, and the stock dropped roughly 50%. The checks that would have caught all this take under 60 seconds. 3 questions. Is the stock price declining over the past year? Is the payout ratio above 80%? Has the dividend been cut in the last 5 years? If the answer to any of those is yes, that high yield is a warning sign, not a reward. That doesn't mean high yield is always bad. There is a stock in this portfolio paying over 5% right now, and it passes every single one of those checks. You will see why when I build the portfolio. Now you know what to avoid, but knowing what to avoid only gets you halfway. You still need to know what to look for, and even among safe, reliable dividend payers, there are 2 completely different strategies. Which one you pick changes what your portfolio looks like 10 years from now. 2 stocks, both safe, both reliable, both pass every check from the last section. Verizon pays roughly 6% today, dividend growth rate around 2% a year, 21 consecutive years of increases. Lowe's pays roughly 2% today, dividend growth rate around 16% a year, 62 consecutive years of increases, a dividend king. On $1,000 invested right now, Verizon pays about $62 a year in dividends. Lowe's pays about $20. Verizon is handing over 3 times as much income today, but Lowe's is growing that payment roughly 7 times faster. Stick with me on this one. By year 11, Lowe's would overtake Verizon, same $1,000, and from that point forward, the gap does not close, it widens every year. By year 20, the stock that started at $20 a year is paying multiples of what the stock that started at $62 is paying, on the same $1,000. The only difference was the growth rate, and 20 years of compounding turned that difference into a gap so wide that the high yielder can never close it, no matter how long you hold. Neither one is wrong. Verizon is for someone who needs income right now. Maybe they already retired, maybe they need cash flow today. Lowe's is for someone building toward the future. The smartest portfolios do not pick one school, they blend both. Alright, so now you know what to avoid, and you know the 2 strategies. But if someone hands you a stock right now and says this is a great dividend investment, how do you actually check? How do you know if they are right? It takes less time than you think. The red flags from the yield trap section tell you what to stay away from. Now, here are the green flags, the 3 things that tell you an investment is actually worth your money. First, consecutive years of payments. Has this company paid a dividend every year for 5 years? 10? 25? A company that is paid through recessions, rate hikes, and market crashes is a different category entirely from one that started paying 2 years ago. A long track record does not guarantee the future, but it tells you the company survived everything the market threw at it and kept paying. Second, the dividend growth rate over 5 and 10 years. The payment needs to be increasing. A stock that has paid the same dollar every year for a decade is not stable, it's stalling. And compare the 5-year rate to the 10-year rate. If the 5-year number is lower, the growth might be slowing down. That is worth knowing before you buy. Third, payout ratio. What percentage of the company's earnings goes out as dividends? Below 60% is healthy. The company is keeping enough to reinvest and grow. Above 80% is where it starts getting tight. Above 90% is a red flag. There is no room to absorb a bad quarter, and a cut becomes a real possibility. Walgreens was at 291%. That number alone told the entire story. Those 3 checks take under 60 seconds on any financial site. Consecutive years, growth rate, payout ratio. That is the entire scorecard. And it works fast. Pick any dividend stock, pull up its page on any financial site, and in under a minute, you know whether it deserves a deeper look or a pass. If it has 20 years of consecutive payments, a dividend growth rate above 7%, and a payout ratio under 60%, it clears the scorecard. If the payout ratio is at 95% and the growth rate has been declining for 3 years, you move on. You do not need a financial advisor to tell you that. The numbers tell you themselves. In Phase 3, I'm going to use these exact checks to pick 5 investments, and I will show you how $5 a day across all of them is projected to reach over $800,000 and pay over $6,600 a month by year 30. But first, there is one more filter to go. If your entire portfolio is 5 individual stocks and one of them cuts its dividend, you feel it. There is a way to build a foundation underneath those picks so that one bad company does not break the whole thing, and for that you need an ETF. An ETF holds dozens or hundreds of stocks inside one package. When you buy one share of an ETF, you own a small piece of every company inside it. One purchase, instant diversification. If one company inside the ETF cuts its dividend, the other 99 keep paying. An individual stock is a direct position in one company. If you pick right, the reward is higher than any ETF could deliver. If you pick wrong, there is no cushion. Here's how I think about it. The ETF is the house. Walls, roof, foundation. Individual stocks are the furniture, or in the investing world, we call them satellite stocks. You do not furnish a house before the walls are up. You build the core of your portfolio around an ETF first. Then you add individual stocks. Companies you have researched, companies that passed every filter from this phase. The foundation first, then the edges. That is Phase 2 done. You can spot a trap, you know both strategies. You can read a track record in under a minute, and you know what holds a portfolio together. Now comes the part you've been waiting for. Phase 3. I take everything from the last 10 to 15 minutes and turn it into a real portfolio. This is where all of it comes together. Time to build. 5 investment portfolio, $5 a day, inside a Roth IRA, which means every dollar of dividend income and every dollar of growth is tax-free. Every pick earned its spot through the filters you just learned, and I'm going to show you why, one at a time. The core is SCHD, the Schwab US Dividend Equity ETF. This is the foundation, the ETF from Phase 2, the walls, roof, and base of the portfolio. It holds over 100 dividend-paying stocks, and to get into the fund, a company needs 10 consecutive years of dividend payments. Then, 4 additional financial screens on top of that. Every year, the fund updates its lineup. Companies that stop meeting the standard get removed. That self-cleaning mechanism is what separates SCHD from dividend ETFs that end up holding yesterday's winners. SCHD carries a 3.45% dividend yield, a 10.43% dividend growth rate, and an average annual appreciation of 8.59%. And that annual rebalance is what keeps those numbers honest over time. The foundation is set. Now the satellites, 4 individual stocks, each one doing something different for the portfolio. First satellite, REXR, Rexford Industrial Realty. This is a real estate investment trust focused on industrial properties in Southern California, and this is the stock paying over 5% that I mentioned earlier. It carries a 5.12% yield with a 12.63% dividend growth rate and 6.52% annual appreciation. Now, remember the yield trap section? A high yield is only good if the fundamentals back it up. REXR's payout ratio is sustainable, the stock price is not in freefall, and there is no dividend cut history. Every red flag check clears. This is a high yield that is earned, not borrowed. Second satellite, ABBV, pharmaceutical company. This is the all-rounder of the portfolio. the highest appreciation of any holding at 13.33%, paired with a 3.33% dividend yield and a 12.22% dividend growth rate. It scores well on the track record scorecard and delivers across both schools from the growth versus yield section. Third satellite, PEP, PepsiCo. People buy soft drinks in recessions, in booms, and in everything in between. That is why this stock is here. It's not the flashiest name. The annual appreciation is the lowest in the portfolio at 4.12%, but it carries a 3.62% yield with a 7.31% dividend growth rate backed by decades of payments through every market condition imaginable. Fourth satellite, TSCO, Tractor Supply. And this is the 19% growth rate I've been holding back. Tractor Supply carries the lowest yield in the portfolio right now at 2.13%, but its dividend growth rate is 19.24%, the highest by a wide margin, with a 9.74% annual appreciation. This is the Lowe's effect from earlier running even harder. The lowest income today, the crossover stock that does some of the heaviest work in the long run. Now that the portfolio is built, the next step is to figure out what the portfolio pays as a whole. Each stock has a different yield, so you need one number that represents all five together. Since each investment gets an equal share of the portfolio, you just add up all five dividend yields and divide by 5. SCHD at 3.45%, REXR at 5.12%, ABBV at 3.33%, PEP at 3.62%, and TSCO at 2.13%. Add those up and divide by 5. The portfolio's blended dividend yield is 3.53%. You do the same thing for the dividend growth rate and the share price appreciation, and those come out to 12.37% dividend growth rate and an 8.46% average annual appreciation. It is that 12.37% in the middle doing the work that does not show up until the later years. Alright, the portfolio is done, but here is a question I never see anyone answer. You have the drip running, the dividends are reinvesting, the snowball is growing. When do you actually stop and start taking the money? The answer is simpler than people think. You stop reinvesting when the dividend income hits the amount you actually need. If your target is $6,000 a month and the portfolio is paying $6,000 a month, you turn off the drip and start collecting. And here's what people get wrong. They think the portfolio stops growing when you flip the switch. It does not. The stock prices still appreciate. The companies still raise their dividends every year. The only thing that changes is the dividends stop buying new shares and start going into your bank account instead. You're not dismantling the machine, you're living off what it produces. The hardest part is not knowing when to flip. It is trusting that the machine is big enough. That is why the projection matters. It tells you exactly when the income crosses your target, so you are not guessing. You're watching a number you plan for arrive on schedule. So let me show you what this portfolio actually does over 30 years. By year 1, you would have invested $1,825. This sets the stage for future growth. By year 10, you would have invested $18,250 over a decade. The portfolio would be worth $33,501, and the dividends would have grown to $1,392 a year, roughly $116 a month. That is not life-changing money yet, but the curve is bending. The compounding loop from phase 1 is starting to show. The account is growing faster than your contributions alone can explain. The snowball is small, but it is real. By year 20, you would have invested $36,500. The portfolio would reach $168,508, paying $10,525 a year in dividends. That's over $800 every single month. By year 30, the total amount invested would be $54,750. The portfolio would grow to $890,893. The dividends would have climbed to $79,996 a year. That is $6,666 every single month on $5 a day. $6,666 a month is more than most full-time jobs in this country pay after taxes, and you would not have sold a single share to get it. Of that $890,893, you put in $54,750. The rest, $836,143, was built by the machine. Capital appreciation added $406,900, but the reinvestment loop, the one from the beginning of this video that felt like it was doing nothing, generated $429,243. The compounding loop created more wealth than the stock prices going up. That is what $5 a day and 30 years of patience actually looks like. If you want to see what happens when you take this even further, 25 bucks a week into Fidelity index funds, projected to surpass a full-time salary at 4,800 bucks a month, that video is right on the screen.